Many Nigerian businesses pay more tax than they should not because they are highly profitable, but because they misunderstand what the law allows them to deduct. Welcome to A Stitch in Tax Saves Cash, the channel where we break down Nigeria's tax laws in practical, real-life terms to help you stay compliant, reduce risk, and legally save cash. My name is Olatunji Abdulrazak, founder and CEO of TaxMobile Online, a professional tax knowledge platform created to support taxpayers, tax professionals, and tax administrators across Nigeria and Africa. In today's episode, we are examining Sections 20 and 21 of the Nigeria Tax Act, 2025, which define what expenses are allowable and what expenses are expressly disallowed when determining taxable profit. This is a topic that sits at the very heart of corporate income tax. So, why does this matter so much? Well, most tax audits in Nigeria result in some form of expense disallowance. Many expenses that seem perfectly reasonable from a business perspective are simply not deductible under the law. And with the new Nigeria Tax Act, 2025, enforcement is becoming more structured and far less discretionary. Getting this wrong leads to serious consequences: additional tax assessments, penalties, interest, and even professional exposure for the tax practitioners involved. Understanding what you can and cannot deduct is not optional, it is absolutely foundational to tax compliance. The core principle governing deductibility is a simple acronym, WENR. For any expense to be deductible, it must be incurred wholly, exclusively, necessarily, and reasonably in the production of income. Section 20 of the Act tells us what the law allows, while Section 21 tells us what the law explicitly forbids. You must read both sections together. One gives you relief, the other protects government revenue. Let us start with the good news: what is allowable under Section 20. First up are employment and staff costs. This includes salaries, wages, allowances, benefits, and contributions to approved pension or provident funds. The law encourages you to take care of your staff, but only within statutory boundaries. Any contribution to an unapproved fund, for instance, won't be allowed. Next, we have finance and operational costs. This covers interest on loans used for the business, rent for business premises, and repairs and maintenance of business assets. However, there are important limits. You need to be mindful of thin capitalization rules, which restrict how much interest you can deduct on related party loans. Also, all related party transactions must comply with transfer pricing regulations. Then there are bad and doubtful debts. Bad debts can be deducted, but only if they are proven to be bad to the satisfaction of the tax authority. Simply making a provision in your books isn't enough. Evidence is everything. For doubtful debts, the estimate must be in line with generally accepted accounting principles. But a key exclusion here is related party debts. You generally cannot claim a deduction for those. A fantastic provision for new businesses is the one for pre-commencement expenses. Costs incurred up to 6 years before your business started are deemed to be incurred on your first day of business and can be deducted. This is incredibly important for startups, tech companies, and project-based entities that spend a lot before generating their first naira of revenue. Finally, Section 20 now includes special incentives for research and development, disability-related expenditure, and distributions from approved real estate investment trusts. This shows the law is actively supporting innovation, social inclusion, and long-term investment. Now, let us move to the other side of the coin: what is expressly disallowed under Section 21. The first category is capital and private expenditure. You cannot deduct the cost of acquiring a capital asset, repaying the principal on a loan, or any expenses for domestic or personal use. For example, if a company pays for a director's personal vacation, that's not a deductible business expense. The second major area is taxes, penalties, and non-compliance costs. You cannot deduct income or profit taxes. It makes sense, right? You can't deduct the tax itself from the profit used to calculate that tax. More importantly, you cannot deduct penalties and fines for breaking the law. This also extends to costs like that you failed to charge or import duty you didn't pay. Essentially, you cannot deduct the cost of your own noncompliance. Next, we need to understand the difference between accounting and tax. Your accounting profit is not your taxable profit. Items like depreciation and impairment losses, which reduce your accounting profit, are not deductible for tax purposes. Instead, you get capital allowances. Similarly, general provisions and reserves are not allowed. And if an expense is linked to generating tax-exempt income, that expense is not deductible against your taxable income. A huge area of focus now is related party and transfer pricing infractions. Any payment to a related party that is not at arm's length, meaning it is not at a fair market price, will be disallowed. The same goes for payments that don't comply with transfer pricing regulations or are part of an artificial arrangement designed to shift profits. Transfer pricing compliance now directly determines deductibility. Let's look at a few practical case studies. Imagine a company writes off a specific trade debt from a customer who went bankrupt. That's deductible. If 2 years later, they miraculously recover part of that debt, the recovered amount must be added back to their income for that year. Consider a tech startup that spent 2 years developing its software before launching. The salaries of the developers and other revenue-related costs incurred during that pre-commencement period are deductible. However, the cost of the servers they bought is a capital expense and will be subject to capital allowances, not an outright deduction. Think about a company director. The company pays his salary and makes contributions to an approved pension fund. Both are deductible. But if the company also pays his children's school fees, that's a personal expense and will be disallowed. Let's say a business buys goods from overseas and pays with dollars sourced from the parallel market. For tax purposes, the expense can only be deducted at the official CBN exchange rate. The difference will be disallowed during a tax audit. And finally, if a company is fined by a regulator, that fine is never deductible. If it contributes to a pension fund that hasn't been approved by the relevant authorities, that contribution is disallowed. And if it receives an insurance payout for damaged goods, that payout must be netted off against the expense claimed for the damage. So, what are the key takeaways? First, not every expense reduces your tax bill. Second, documentation is what determines deductibility. Without proof, it's just a number in your books. Third, Sections 20 and 21 are two sides of the same coin and must be considered together. And finally, managing your expenses properly is now a core part of tax risk management. Tax savings begin before you file your returns, not during an audit when you're trying to defend your position. For professionals, always remember to separate accounting profit from taxable profit. Review all your deductions carefully before filing, and when in doubt about gray areas, always seek professional judgment. Proactive engagement with tax authorities is always better than a reactive defense. If this episode has helped you understand what truly saves tax and what the law will never allow, then it has achieved its purpose. Please like this video, subscribe to A Stitch in Tax, Saves Cash, and share it with a business owner, finance manager, or tax professional preparing for the 2026 tax regime. I am Olatunji Abdulrazak, founder and CEO of TaxMobile Online, and I will see you in the next episode.